Okay, hello. My name is Dave Zapponi, and I'm the CEO of ECHO, the Educational Council of Homeowners. I want to thank you all for participating in today's Ask the Expert About Insurance event. We will be focusing today on HOA insurance. Remember to please mute your mic and turn off your cameras if you are not one of the speakers. ECHO is a statewide nonprofit association established to support HOA board members and engaged homeowners. Our mission is to foster a better quality of life in community associations through education, advocacy, and connections. For today's event, we have a few housekeeping items that I'd like to go over with you. These are now on the screen, and they were sent to you in advance of the program. Please reconnect with these and refamiliarize yourself with these housekeeping items. In addition, slides were sent to registered attendees beforehand. Please take a moment to review the housekeeping items. We have many HOA board members in attendance today, which usually means there's going to be a lot of questions. We will ask the experts the questions directly in our two 20-minute breakout sessions. I'm going to try to answer a few of the easier ones by typing in the answers during the program. Please use the chat feature to report any technical issues and to communicate directly with other participants in the webinar. You will find the chat icon by hovering over the bar at the bottom of the page. I will respond in writing to some of the common questions. Please keep your questions general in nature. Questions about specific situations are better asked directly of your professional counsel. And now for our disclaimer, which you'll find on the screen. None of what is said during this seminar shall be construed as specific legal or expert advice from the speaker, sponsors, or ECHO. If you wish specific advice, we encourage you to contact your attorney or another suitable expert, your insurance professional, and get specific advice from them. Thank you. Today, we have several sponsors. Please join me in thanking our panelists. Kevin Boland Insurance, please thanking our sponsors. The Kevin Boland Insurance Agency, Modus Insurance Services, and Social Insurance Agency. These three will be our panelists today. Our premier sponsors, Silver Creek Association Management, and our breakout room sponsors, George Peterson Insurance Agency and Spina Insurance. We will now hear a brief message from our premier sponsor, Laura Ravazza of Silver Creek Association Management. Laura?
Hi, I'm Laura Ravazza with Silver Creek Association Management. Our core mission at Silver Creek and the touchstone of everything we do is to manage communities with its people in mind. That means we don't just aim to check off standard management boxes, but to listen and cater to the unique individual needs of each and every member of a community. We believe in enhancing the livelihood of communities through our unparalleled dedication to customer service, our ability to offer professional expertise in all areas of HOA management, and our tireless drive to ensure that the communities we take care of are heard, happy, safe, and thriving. We aim to consistently go above and beyond the confines of typical HOA management duties. It's because we genuinely care about how your community functions. We understand that managing a community can be a demanding responsibility, but our team of experts understands how to get things done with efficiency and finesse. Please let us know how we can help you and your community. I hope you have a great education workshop today.
Thank you, Laura. And thank you to all of our sponsors. They make this event affordable to everyone. All our sponsors today will be available during our two scheduled breakout sessions. The Kevin Boland Insurance Agency, Modus Insurance Services, Social Insurance Agency, George Peterson Insurance Agency, and Spina Insurance will be available to tackle any of your insurance questions that you may have from the presentations or that you may have brought with you to the seminar. The community management firm, Silver Creek Association Management, will be able to address questions from an association manager's perspective and help you with what insurances they believe you need and how to select an insurance agency for you and your association. Before we get started, let me briefly introduce each of our panelists. Charlotte Allen has been with Social Insurance Agency since 2005. As Director of Marketing, Charlotte works collaboratively with agents to highlight social services, knowledge, and dedication to their clients. Her commitment remains focused on educating common interest developments and their community leaders on some of the most prevalent and challenging issues facing HOAs today. Dan Wallace is president and founder of Modus Insurance Services and is the creator of Common Interest Development Unit Owners Earthquake Policy Form, approved by the Department of Insurance in 2017. Dan has over 15 years of experience in the insurance industry and is a third-generation insurance professional. Dan has helped author multiple articles on the current shortcomings of earthquake insurance in California. Kevin Boland has been a successful farmer's agent since 2002. His agency is based in Novato, California. Kevin has 3 important industry credentials: the LUTCF, or Life Underwriters Training Certificate Fellowship, the CIC, Certified Insurance Consultant Credential, and the AIC, or the Associate in Managing Claims Credential. Mr. Boland graduated in 1984 from the University of California at Berkeley. Kevin regularly writes articles for the Echo Journal and gives HOA insurance talks when asked. He manages the insurance needs of more than 45 homeowner associations, from 4 homes to 400 homes. Kevin also serves on his board of directors of 214 homes. He understands the rewards and the challenges of serving a large homeowner association. And all of those credentials are important. I just had somebody ask me that very question. What does this mean? So now I know. So let's move on to our session. Number 1, we will now move on to the session. So let's go ahead and get going. And I believe Charlotte Allen, you're up.
I am up. Thank you so much for having me. So we are going to talk about a few different things today. The first of which we're going to touch on HOA risk management and the different layers of risk management we can look to as associations. We will get into the wildfire insurance and the general state of insurance in California. I think it's really important that we touch on that. I knew I would be remiss not to bring that up. And then we'll also end with just kind of some basics, or what we consider basics for HOA insurance. So Connor, if you want to get us started with the first slide. Excellent, thank you so much. So there are multiple layers of risk management. And really, it kind of starts from the moment, you call an agent, a broker, to take a look at your property and bid insurance, and it stems from there. So the first layer of risk management, or the first place that we're going to look to, is really the reserve study. So these reserve studies, I think we are very fortunate in the state of California. Not all states require a reserve study. Not all states require a reserve study every 3 years. Not all states, some states require a very robust reserve funding. California, as we know, does require a reserve study be done every 3 years for homeowners associations. And it's a really great look, and it gives us some insight as to what we're dealing with a homeowners association. And this is for both single family homes in like a planned unit development, as well as attached dwellings. Now, obviously, a reserve study for the attached dwellings, where the association is responsible for ensuring the structures, is going to be a little more robust than an association that doesn't have to take the responsibility of those particular structures. But it is a really great starting point to figure out exactly what's going on at the association. The second layer of risk management, and really when I say risk management, it's really getting a strong indication of like what is out there at an association. Because as we know, there's no such thing as a cookie cutter homeowners association. And this is even true if you have a developer that develops two homeowners associations that are quote unquote identical, that sit right next to each other, because the people that make up that community and the people that serve on that board are diverse. And so there really is no cookie cutter association, and also no cookie cutter, or there shouldn't be any cookie cutter insurance policy for these associations, because there's so many nuances to every association. And again, that goes to the makeup of their owners. So the second thing that we want to do is visit the property, actually have boots on the ground and get an idea, a sense of what's going on out there. So what kind of things are we looking for? So when a broker comes out, let's say you call us and you ask us to take a look at something and bid insurance for you, what are we looking for? I assure you, nothing too invasive, but we want to take photographs. We want to have a really clear sense of what you have out there. Do you have common area components, a swimming pool, golf course, you know, trees and shrubs, walkways, breezeways, paved surfaces? These are all things that we're looking for. And then we want to make sure that we're communicating with management. So, hey, you know, we went out there and we saw this. There's a pond that seems to be at the association. Are you responsible for this pond? These are the conversations that we want to have. And this all comes from us actually going out there and having a look for ourselves of the property that you're asking us to insure. For single family homeowners associations, a lot of reliance really is looking to that reserve study to understand, okay, what does the association take responsibility for? How much would it cost to replace those trees, those shrubs, the paved surfaces? And then we want to take that information and run it through a calculating program. There's several of them that anyone in the industry can use. And what we do is we take information from the county assessor's office. And I just want to keep in mind here, the county assessor's office really only gives us the square footage of each individual unit. It really doesn't take into account, like I said, those paved surfaces, those breezeways, walkways, balconies, decks. So that's where it comes in handy that we've actually stepped onto the property, photographed, and taken a look at what else is out there beyond just the unit square footage. So we take all of that information, including, something happened, but I'm still with you, right? Including everything that we photographed and everything that we found from the county assessor's office, and we put it into an industry-wide calculator that gives us the appropriate price per square foot to rebuild at that given time. And I really want to stress this, and I say it slowly and with care, because this calculating system tells us this price per square foot to rebuild at that location at that given time. And as an agency, we rerun those numbers every year, because especially in the state of California and after all of our wildfires, particularly the ones in Napa, Santa Rosa, we know that inflation is very, very real, that the cost to rebuild, currently we're facing an issue of not being able to get materials in some cases, that price per square foot to rebuild can absolutely fluctuate. So we rerun those numbers every single year and have that conversation with you and your community manager, if you're professionally managed, to talk about what type of inflation might be appropriate. All right, next slide, please. All right, so I got ahead of myself because of the little technical difficulty, but we want to understand exactly what an appropriate price per square foot to rebuild would be. And then we need to have a discussion with the board. And I want to be clear, ultimately, it is up to the board to stamp, approval, to sign on the dotted line and say, yes, we are comfortable with this replacement cost to rebuild based on the conversations that we've had with an insurance professional, the conversations that we've had with the board, and, are you asking for your broker for that information, that industry-wide calculator? It's great to kind of see it for yourself and agree or disagree. I want to also make mention that the cost to rebuild an association is far different especially in California and particularly in the Bay Area, than the real estate cost or the real estate price, what you would sell your unit for, what you would sell your home for. And so those are kind of the sticky conversations that we sometimes have with unit owners or new board members, that the cost to rebuild may look very different than the cost of selling your unit. I think it's also really important that you have a clear sense of the insurance value and making sure that you are in fact insuring appropriately, because there are some penalties that we can face if you're underinsuring or undervaluing the association. We'll get a little deeper into that as we go, so I'm not going to spend too much time here on that, but there are some penalties. And then we want to take that information out to market. So this is another layer of risk management. We have a really clear sense of what the association has and what the association has to insure based on all of the components that we've looked at and the governing documents. And then we take it out to market. So because we're a brokerage, we typically take this out to multiple carriers. But we're very competent in where we take it, because if, let's say, your association has a unique underwriting characteristic, for instance, maybe you have wood shake roof shingles. So for those of you in the room that don't know, wood shake roof shingles are highly dangerous. And I don't necessarily suggest that you look at video of it because it's quite devastating. But when there's a fire within a building that has those wood shake roof shingles, the structure is almost immediately gone. They're highly flammable. It's a really dangerous situation. And there's many insurance carriers that do not want to insure a property that has something like that, the wood shake shingles, or for instance, you know, an unfenced pool where it's a free for all, anyone can get in. So we want to take all of the information and knowing what's out there, knowing what the characteristics of the association are, we want to take it to insurance carriers that can actually offer coverage for that association based on those factors. We want to avoid carriers that will decline based on the characteristics of the association, or that will, if they find out that the association has those dangerous characteristics, will get off of the account midterm. No one wants that. It makes us look bad as a brokerage. It makes you look bad as a board if you move to a new insurance carrier and then midway through the policy, they want to get off the account because they find out that something's there that they weren't comfortable with. So we want to make sure that we have all of the information. The other thing that we may want to have a conversation about is if there is some type of dangerous characteristic or underwriting issue out there. This is another great, for instance, railings on the second or third story that are greater than 4 inches apart. Insurance companies at times will have issue with writing railings that have a pretty big spread. As we know, kids can slip through, they can fall, it becomes dangerous, it becomes a major loss. So if we can have those discussions up front in the beginning of the bidding process and say, hey, we went out, your association looks great, but we noticed that your railing widths are 6-7 inches apart. You will have multiple insurance carriers open up to you and be highly competitive on price and coverage if you were to modify those railings. Is that something that we can discuss with the board? And if it is that something that we can then go back to the insurance carriers and say, hey, we know, for instance, I'm going to pick on Travelers. We know that Travelers doesn't love railings that are over 4 inches apart, but hey, if this association, bids this work and has it done before the policy period is over, would you be willing to write the insurance as they're in the interim of them getting this done? A lot of times that negotiating can work very well and in the favor of the association. You're avoiding risk, you're taking responsibility for the risk factor there, and you're meeting the underwriting guidelines of a very reputable carrier and paying the most competitive premiums for the broadest insurance coverage. So it is a win-win. Next slide, please. All right. So once coverage is bound, insurance carriers will actually conduct their own inspection. So let's say you've asked us to quote insurance, We talked to you about all those things that I just mentioned. We had great conversations. Travelers is willing to write it. Again, I'm just picking on one carrier, but we have an insurance policy for you. Everything looks good. We sign on the dotted line. Usually within 30 to 90 days, depending on the insurance company, they will go out and run their own inspection as well. And really what they're doing is they're making sure that the risk matches everything that was put on the applications. They're looking at unit count. You know, you said that there were 60 units out there. Do we also count 60 units? You mentioned that there was a swimming pool. Is there in fact a swimming pool? The square footage, you know, do we have any just major discrepancies with that? And do we believe that the insurance value that we've put there is in fact adequate for the association? So those are the things they're looking for. And then on top of that, risk exposures. And I know this can be a little bit frustrating, but they're looking for things that will only help the association in the long run. The idea is you want to mitigate loss because no homeowners association wants to see an insurance claim or wants to see an owner or visitor get hurt. So these carriers are going in and looking for any kind of red flags that they can share with the association. A great example and one that we see all the time, and I think anyone, you know, in the insurance business on this call will say the same thing, is paved surfaces. When there's any kind of like asphalt lifting up or major trip and fall hazards, those are usually pointed out rather quickly when they go in and they do this inspection. So those recommendations or those things that they notice, recommendations can be made from that. More to come. We're going to talk a little bit about recommendations. They may also come back to us as the broker and ask for more information based on what they saw. So if they see, hey, you know what, you said that there were 60 units, but it looks like there's more like 120. And this actually happened. So I've got a colorful example of this. I had an inspector come back to me. We had written on this association and they said, hey, we're at the property right now. And you said it was, 60 units. We show it's 120 units. I'm like, the CC&R states 60 units. I've gone out there myself. I have photographs. I have a plot plan. Like, this can't be. So I started looking at the photographs and I realized there is an identical homeowners association next door. Same developer, looks the same, slightly different color of buildings, but that can happen. There can be a fluctuation within a community. And they thought that it was all one homeowners association. So no big deal. I'm glad that they called me first and didn't call the client saying, what the heck, you misreported. And it was easily rectified. They acknowledged that, yes, there are two different homeowners associations. Sorry about that, moving on. The other funny, colorful example, I got a phone call from an inspector that said, there's a car wash at the association. And that is an issue for us. We think that that's gonna be a liability issue and we need to make sure that we either collect premium for it or get off the account because we're not sure that we're comfortable with a car wash. And I'm like, again, I've gone out to the property. What are you talking about? There's a car wash. So I said, well, can you send me a picture of what you're seeing? And they sent me a picture. And in this common area, there is a hose wound up in a common area space and a sign on the hose that says car wash, meaning please feel free to use this hose to wash your car. But is there a Duckies, business taking place on the association's property? Absolutely not. So, I tried not to laugh too hard at the inspector, but I assured them that a hose in which people can use to wash their cars is far different than having an actual car wash exposure. So those are just some of the funny things that have come about from the inspection. Next slide, please. All right, so we're going to get to those recommendations that we talked about. And I always like to use this, this cartoon. So you see the inspector there saying, of course you have ants. You live in a giant cookie. So, of course you have slip and fall issues because your asphalt is lifting and it's cracked in, various places. So it's important that we take these recommendations seriously, but I also want to remind the audience that not all recommendations are mandatory. Meaning if an association or if an inspection is done and they say, hey, we noticed that there's asphalt cracking in the upper right-hand corner of your association. Okay, that's good to know. It's something that we can keep in mind. We can make sure that the reserves are adequate for that. We can make sure that when we go out for the bidding process that that is dealt with. But it may not be necessary or mandatory that it's dealt with immediately to move forward with the insurance policy. So it's really important that you have that talk with your insurance broker and find out, is this recommendation mandatory, or are they in fact just letting us know that, hey, this is something that should be on your radar? If it is mandatory, this is an example. They went out and inspected, and the fire extinguisher tags were expired. Now, the next thing we know that this is mandatory. You have to renew those inspections, and you have to have new tags on your fire extinguishers. But the next thing we want to do is determine a timeline. So this is up to us as the insurance professionals to negotiate that timeline. Yes, we recognize that they need to do this. This is going to take them a couple months. They need to bid it out. And once that's all taken care of, we'll sign on the dotted line, good to go. So this is something that we can negotiate with the insurance company. And keep in mind, every carrier has different underwriting guidelines. So going back, to when we first go out to market, if we know that your association cannot afford and you're not willing to change those balconies and close those gaps from 8 inches to 4 inches or whatever is deemed safe and necessary, we know that we've had that conversation with you. We're going to make sure that we take it to insurance carriers that are still willing to write insurance, even though you have that wide gap. But every insurance carrier does have their separate underwriting guidelines. I always kind of say jokingly, for every insurance carrier that doesn't want to write coverage for your association, there's 5 more lined up that do. Recommendations are plain and simply an effort to avoid loss. So I know it can be frustrating to be surprised with something, to be told that you've got cracks in asphalt that you weren't aware of, but just if we can keep in mind that it's really an effort to keep you as the board safe from liability, and your association and any visitors, owners, visitors that visit the property, safe from harm. The carrier ultimately does not want to be a maintenance policy. Their job is to insure, not maintain. That is still the association's responsibility. And again, going back and saying, how can we avoid these recommendations? Make sure your broker visited the property. 9 out of 10 times, if we notice a red flag, like the railings that are more than 4 inches apart, we will say something about it. We will notice and we will say something about it. So there are ways to even avoid a recommendation. Go to the right carriers, make sure you have an understanding of what's out there, and make sure you're reporting that to the insurance carriers accordingly. Next slide, please. And then I want to just talk about some common risk exposures, because we talked about, hey, for every one carrier that doesn't want to write your association, there's 5 more lined up that do. I think that we should also talk about some of the most prevalent exposures that carriers want to avoid in general, or have issue with, or need to ask more questions about. And that number 1 is going to be age. So if we have an aging building, insurance carriers are going to want to know what type of updates have been done. Makes sense, right? We just want to make sure that you have the safest building out there. Another factor that they're going to look at is rental percentage. It is believed that the higher the rental percentage, the less likely of superior maintenance to an association, that if you have renters, that they may not have an invested interest in the association, and therefore might not take care of the units the same way an owner-occupied unit would. So they want to look at that rental percentage. And again, every underwriter is going to have, or every insurance carrier is going to have their underwriting guideline nuances. So that, some carriers would rather not see anything exceed 25% rental. Some have no issue if you're, up to 50%. The other thing that they're going to look at always is loss history. So you guys know, when you go out to bid, the first thing that the person asks for, the broker asks for, is that loss history. Because really what the insurance company is looking at is there a pattern in losses? Are there 5 water losses in the last 2 years? that indicates that there's something bigger out there. There's some issue going on. They want to look at the frequency. They want to look at the crime rate. So it is important that they take a look at that loss history. And then it's important they have a conversation about it. So, I've got associations that may have had a fluke incident, a fire loss that was, the likelihood of it ever happening again is nil. It's important that we have those conversations with the underwriters as well. Again, talked about it a lot, the upper railing widths, wood shake siding and roofs, and then wildfire mapping exposure, and most currently electrical panels. And I think we're going to dip into wildfire now. If you can go to the next slide. All right. So again, I just felt like I would be remiss not to discuss wildfire exposure, especially to our California owners. As we know, more than half of the 20 largest fires in California history burned in the last 4 years. And you can see this on the graph here. You can see where we are. And basically what that tells us is that there is a danger, there is a very real danger of wildfire continuing to spread throughout California. Next slide. And so the powers that be came up with a mapping system. And I have to tell you, I always give this disclosure, this map, and again, any insurance professional on this call can shake their head, is ever changing. So I wouldn't say that it changes day to day, but certainly the mapping changes. So I call this kind of more of a live document. But you can take a look. This was, a map that I got maybe a couple months ago. But you can see the red areas are where CAL FIRE has found the most extreme wildfire danger. Next slide, please. So we know that there's wildfire danger out there. I think that it's important that we talk about the insurance perspective. And I want to be clear, I do not work for an insurance company. As a broker, I get to work for the insured. I get to work for you. And I don't always have the most lovely things to say about insurance companies. However, I think it's important that we understand their perspective. So an insurance company, at the end of the day, is a business, and they need to stay in business. And in order to do that, they really need to have the appropriate reserve funding in the bank to pay claims at any given time. It's just, right? It's how you do business. You collect money and you pay money for the claims, and you need to make sure that you have enough money to do what you've set out to do, what you've contracted with clients to do. And so there is a rating system, it's called AM Best, that can tell us, for an insurance company, their financial strength, how much money they have to pay claims, and how well are claims paid? How well do they do business? And so it's just like being in school. You get a letter grade. So I've got the chart here. You can see, A++ is superior. It means you pay claims, you do a great job. The financial strength is represented by a Roman numeral. Again, you can see the chart here, and that tells you how much money do they have in reserves right now to pay claims. So the higher the letter grade and the higher the Roman numeral, the more sense of security you can feel with an insurance company. Next slide. So the current situation for HOAs in high fire danger zones. So those that we looked at the map, those that are experiencing the highest risk of wildfire. The insurance carriers are scrutinizing more than they ever have before. They're really taking a look at what associations do we want to write? What properties do we want to write based on their fire score, based on how dangerous they are? And some carriers are non-renewing policies that they've even, some have been writing them for years and years and not had one fire loss. And now suddenly they're non-renewing policies. So we're seeing some of this happen. And I'm sure you all have your videos off, but I'm sure some of you are shaking your head and saying, yeah, I was non-renewed. Never had a fire loss in our lives as an HOA, and I'm being non-renewed. And sometimes they're offering only limited insurance. So like you have $100 million association. It's valued at $100 million to rebuild, and you're only able to get $10 million in coverage from a carrier suddenly. Some insureds are being forced to non-standard insurance markets, also known as surplus lines. Next slide. So I think it's important that we talk about surplus lines markets and what that means, because I think it's going to become more standard for a lot of associations that have been in what we consider a standard market for a long time. I want to be clear, this is not affecting all of California. If you look back at that map, we know that there are plenty of associations that are not deemed in high fire. In fact, our agency in the state of California, we insure over 2,000 homeowners associations in Northern California alone, and only about 4% of our book is experiencing some of these non-renewals or increases in premium. So I just want to be clear that this isn't necessarily affecting everyone in California, but because we are a community and because we need to come together, as industry professionals and those that serve homeowners associations, we want to make sure that we take care of one another and that we have a clear understanding of some of the struggles that a portion of us are dealing with. So there's California admitted insurance carriers, and then there's non-admitted. And I think that we can get really scared easily of these non-admitted carriers. Well, what that means is not backed by the state of California, rates aren't authorized. This seems scary to me. And yes, it is different and it can be, but it's not new. It's just different. It's always been used, surplus lines markets have always been used for properties that have a substantial loss history, that have those nuances, those railing widths, things like that, that the standard market just doesn't have tolerance for. And some of the strongest, most financially stable insurance companies are part of this surplus lines market. And the big, for instance, here is Lloyd's of London. We've all heard, I'm sure, of Lloyd's of London. Why? Because Lloyd's of London is in the tabloids. They've got a ton of money. And why? Because they collect money from Mariah Carey. They insure Mariah Carey's legs. They insure Julia Roberts' smile. They've got celebrity money in the bank. Their reserves are high. So they can also charge whatever they want for insurance, but I want to assure you that they actually have some money to back it up. And again, dipping into surplus lines markets, not new, just different. And I would say you probably want to stick with an insurance professional that has experience in the surplus lines market, because an insurance policy is only as strong as its endorsements. And if you don't know, if you're working with someone that's not a specialist, that doesn't actually insure homeowners associations on a regular basis, they may not know what endorsements to look for or ask for these non-standard insurance policies. Next slide. All right, so what are insurance providers doing? Because this is an issue for so many of us. I want you to know that we are working hard to find you coverage. If you're sticking with a specialist, then you know that they are watching the maps and the ever-changing maps. They're following the state guidelines and news. We are constantly keeping in mind the Davis-Sterling Act and the association CC&Rs, because we have a deep, rich understanding of all of the things, all of the guidelines that dictate a homeowners association. We're also collaborating with fellow insurance professionals. I consider them our friendly competition. We're coming together to try to give you the most robust policy at the most affordable premiums. And we're also watching as new carriers enter the market or re-enter the market, and that will happen, and it becomes cyclical as well. Next slide. All right, so I know that I'm running low on time here, so we're gonna jam through this. The good news is anyone that's been on their board for a good amount of time, probably this is going to be review for you. Next slide. So I want to talk about kind of insurance basics, if you will. We know that property coverage provides protection against risks for property, such as fire, wildfire, vandalism, and some weather damage. I think we're lucky most of California doesn't really suffer from major hailstorms, but obviously that can affect some of us. Next slide. And so I'm not going to go too deep into this because we really talked about it already, but an association, when they obtain insurance coverage, they declare the replacement costs of the association assets. So again, that should be a conversation that you're having with your insurance professional based on that industry-wide calculator based on what the professional knows to be at your association, what your CC&Rs dictate. Next slide. Many carriers will institute a penalty if you are underinsured at the time of loss. So it's really, really important that you're insured adequately so that you don't have to come out of pocket as a homeowners association. The good news is lenders, believe it or not, they're keeping insurance brokers honest. Lenders will not want to fund loans or refinances in associations where you don't have enough coverage. So they've done a good job of keeping some brokers that maybe haven't been so honest in the past honest. Next slide. Single family homeowners associations, again, I don't want to avoid talking about those. It's still really important that you insure adequately for your common area exposures. So taking a look at the reserve study, figuring out exactly what's out there. One of my least favorite things is, I get asked, can you quote this apples to apples? I don't believe in apples to apples. I don't want to take another broker's work and decide, yeah, I'm gonna just stick with this. I want to explore the association. I want to see the reserve study. I want to see what I'm putting my name on. And I would recommend that you avoid agents that are simply rubber stamping previous valuations and giving you what they consider apples to apples quotes. They need to do the work. It's important that we as insurance professionals go in and give you our honest opinion based on our knowledge and expertise. Next slide. So is the saying true, you get what you pay for? I believe yes. I was saying earlier, for those of you that joined the call early, I don't like calling things bells and whistles. These are really important endorsements for your insurance policy. So bells and whistles insinuates that they're not necessary. They absolutely are. We're going to talk quickly about building ordinance, sewer drain backup. It's a very standard, important coverage. I like to see it at no less than $100,000. And I only say that because in my 17 years with Social Insurance, the highest sewer drain backup claim I've seen is $90,000. So I think $100,000 is a nice sweet spot, but if you can get up to the policy limits, go for it. Extended replacement cost or guaranteed replacement cost endorsements can be worth their weight in gold. And basically what that acknowledges is, hey, we're insuring you properly up front, but if there's any inflation that we experience throughout the policy period, that 1 year policy period, we will pay up to, let's say, 25% additional if it's extended replacement cost, or if you have a guaranteed replacement cost endorsement, we'll pay whatever it is, even if we experienced inflation during that policy period. You also want to take a look at, insurance companies when you're comparing and contrasting. What's their claims handling reputation? Maybe look at that AM Best rating. Talk to your broker. What's your experience with this insurance company? How well do they pay claims? Next slide. Building ordinance A, B, and C. I'm going to jam through this. I know that we're short on time and I apologize. I knew that wildfire I would be a little long-winded with. Building ordinance coverage A is plain and simply for the undamaged portion of a building. So if half your building burns down, the other half is left standing, you still need to rebuild as a whole. Coverage A is for that undamaged portion of the building. Building ordinance B, again, very simple, it's demolition. But just keep in mind, if you're in a major metropolitan area, let's say you're a stacked, high-rise condominium, demolition may get very costly. We're talking about closing down streets and bringing in major equipment. You may need higher limits of building ordinance B than, say, a more rural area where they have smaller townhomes. Building ordinance C, this is where I really, really want to stress the importance of this, especially for associations that are older construction, because this is for increased cost of construction. And I think the best example of building ordinance or increased cost of construction is fire sprinklers. So if you had an association that was built in 1975 without building fire sprinklers, and now the building burns down and needs to be rebuilt, and the city or county ordinance requires that you have building the fire sprinklers, your insurance policy will not pay for anything that did not exist prior to the loss unless you have this building ordinance C, increased cost of construction. That will pay for those fire sprinklers. Or let's say you have a 3-story building and it was built without an elevator. ADA requires that you have an elevator now. It will pay for the elevator. Next slide. Make sure you have D&O insurance. I stand by a standalone policy, not an endorsement to the policy. Major difference being, if you read an endorsement to a liability policy where, let's say State Farm says, here, here's your whole package policy and there's D&O thrown in, look at the endorsement. You're lucky if it's one paragraph. It will tell you a little bit about what it may cover. It does not give you a whole lot of endorsements or exclusions. Standalone policy, you're looking at, a 35 to 60 page document that tells you exactly what to expect if you as a board member are sued, if you're accused of anything. Pay attention to the D&O policy, make sure there's not an exclusion for non-monetary damages. And I'm sorry, D&O is directors and officers liability coverage. That is what protects you as the volunteer directors for your association. So even if you make a decision and you think it's in the best interest of the association, but you can be accused of anything. You can be accused of discrimination for making that decision. You want to make sure that you have this to protect your personal assets. Also, you want to make sure there's no exclusion for manager as additional insured. So if you're using a wonderful community manager, they deserve to be additionally insured in their capacity at working with the board. Next slide. Dave, do you want to kick me off?
We're at time right now. Just go ahead. I think you only have 2 slides left anyway. So
okay, perfect. So umbrella liability, I want to be clear, this does increase the limits of the existing underlying liability policies. So an umbrella policy can extend over your general liability. If you have a $1 million general liability policy, but you have a playground or a swimming pool or anything else that can be a bit dangerous, you may want to go ahead and increase your umbrella liability policy. And it should, again, you want to pay close attention to your umbrella policy. It should also extend over your directors and officers liability. So again, if you have a $1 million umbrella or D&O policy and you have a $5 million umbrella, then you ultimately have up to like $6 million if there's some type of case against you. And it does not enhance property coverage. The umbrella liability policy is only for underlying liability. Next slide. Earthquake, I'm not going to dive too deep because we're going to talk about this with the one and only Dan Wallace, but there are options out there, the first of which, and probably the most ideal as far as coverage is concerned, is to insure the entire association with a master policy. You can also put together individual policies, make sure that all of the unit owners are purchasing something. And then there's this really cool opt-in program, which Dan will talk to you about today. It's called Modus. Next slide. All right, I did it. I'm so sorry.
no worries. So thank you so much. Bringing everybody back into the general session. I want to say thank you for the breakout that you had. And let's go ahead and kick off the second session with Dan Wallace. Remember to mute yourself and make sure you turn off your cameras. Thank you, Dan.
All right, thanks for having me. My name is Dan Wallace. I had that very nice bio that they said about me earlier. I am a program minister for earthquake and flood products around the country, and now we're in British Columbia, Canada as well. I sell my products through agents and brokers that are on this panel. And so today we're going to talk about earthquake insurance. I'm just going to talk about some best practices, great ways to kind of conceptually think through earthquake insurance because it's very challenging. In California, we're in a very tough market with insurance. For the rates for earthquake insurance have been going up for the last 5 years. So it's, how do we get creative? How do we think about this problem? I guess next slide. And so people always want to know, when's an earthquake going to happen? And so the top seismologist, and a great anecdote, story to tell here, is the top seismologist in the world went and measured a particular spot in the San Andreas Fault because that's our largest fault, that's our fastest moving fault. What can we learn? When is an earthquake going to happen? And people really don't want to know when an earthquake's going to happen because over the last 40 years, just on this one fault, we've had 700,000 earthquakes. Really, we have small ones moving small earthquakes every single second of every day. We want to know when's the next big one. And so when the seismologist went and measured Fraser Park, the San Andreas Fault, we learned that, and it's actually been 170 years since our last major shake on the San Andreas Fault. But what we learned is, there's nothing really predictable, right? And so we look at earthquakes insurance as a 50-year, 200-year event. There was one time where the distance between a major fault, a major slip was 300 to 400 years. And so, what we really learned from this when the seismologists went out there is we really can't predict when the next big one will be. We just have to know and understand that we roughly have a 1% to 2% chance every year that your home will be affected. Next slide. And here's one. The only reason I put this up here is developers are not your friend. Unfortunately, they'll tell you that your home is going to be not affected by an earthquake. That's really just not true. California is way behind the rest of the world in terms of building codes for earthquakes. In California, we still have this, which is wild. It's called preservation of life, and which means that if you can crawl out of your home, that's a success. We accept that this is for brand new construction. We accept that only 90% of brand new construction will not collapse, which also means that we accept that 10% of new buildings will collapse. And for every building that collapses, there will be 9 more that'll be red tagged. And what that means is there's partial damage, but a city engineer comes out and says, you can't rebuild that, you have to knock it down. So in California, we just allow these things to collapse. It's not great. Next slide. And here's just some, there's some theoretical we talked about. Here's some just empirical stuff. Here's some data information on earthquakes. California, we have strip slip faults, which slide side by side. Historically, these affect smaller buildings than larger buildings. We don't have large magnitude quakes like you could have through subduction zones. But as we'll learn quickly, empirically, they really do affect smaller buildings, multifamily homes. In Northridge, we had a 6.7 magnitude with $40 billion in damages. I noted, I think it's 75% of all residential buildings that were damaged, units that were damaged, were multifamily. A lot of the condo associations and apartments are very vulnerable in California to strike slip faults. Loma Prieta, very similar story. That's why I have it here. It was a 6.9. That's still only a moderate quake. That's not a large quake. We had 12 billion in damage. And again, 75% of all red tagged residential units were multifamily. An interesting story on Loma Prieta, just shows modeling is so hard, is usually when we have an earthquake and we do models, we assume all the damage is going to be within 5 years or within 5 miles. But for Loma Prieta, the epicenter was in the Santa Cruz Hills. All the damage was in Oakland, over 50 miles away. So the intensity of the shaking is really hard to predict because a lot of that comes to soil, and it's just really hard to predict. So just because you don't live within 5 miles of an earthquake does not mean your property is not going to be vulnerable to intense shaking. And then, as I showed you before, how we kind of try to predict earthquakes is within 50 years, what's the probability of your home being affected? Right now in the Bay Area, roughly there's a 72% chance we're going to have another Northridge type earthquake by 2050. Basically in California, it's a virtual certainty by 2050 we'll get another one. There's a 93% chance that we'll get something 3 times stronger than Northridge in the next 30 years. And there's a 50% chance we could get something 16 times stronger than Northridge in the next 30 years. So again, as I said, every year we have a couple % chance of a significant earthquake. How do we prepare? Next slide. What I always try to advise, I actually stole this deck from an attorney, is what boards can do is to reduce potential damages, both physical and financial, is if you're a manager, you're a board, reach out to your agent, reach out to your attorneys, get the best advice for them. And it's important to do that and document that, because if you're a board member, it protects you. You just have to document everything, because again, if you're going to get sued as a board member, you're going to get sued under the business judgment doctrine. And the best way to protect yourself is to document that you did your due diligence, because in the state of California, there really isn't a requirement for you to buy earthquake insurance. Your CC&Rs can be vague, but whatever you decide as a board, just document it and reach out to the professionals. Next slide. Now, how do you pay for earthquake damages? That's a great question. So I think, as Charlotte mentioned, you can do the community earthquake insurance. A board can buy earthquake insurance on behalf of everyone. Without doubt, that's the best way to do it. The reason why we've been so resilient in the past, in Northridge, over 40% of communities had earthquake insurance. Northridge got back to their feet really quickly. So if you can afford earthquake insurance, that's always the best to buy on behalf of everyone. That makes rebuilding much, much easier. If you don't buy earthquake insurance, just let your community know you're not buying earthquake insurance and what that means to them. And if your association doesn't buy earthquake insurance or buys partial coverage, that means you're leaving your unit owners with large special assessments. And just let them know, just if we don't have earthquake insurance, everyone has a potential assessment of $200,000, $300,000, $400,000. Your broker can work with you and let you know what everyone's earthquake special assessment exposure is. Just let your community know, because unit owners can go buy assessment insurance on their own. And then I think what a lot's not talked about, what should be talked about, is a very important part of rebuilding is post-earthquake financing. One is, obviously, we said large special assessments. Those will be paid through individuals having insurance, individuals getting second loans, or individuals paying from their own liquidity. If a unit owner doesn't, their lender will step in, pay those assessments on their behalf. And then borrowing is really, really important. So anything you don't pay by an assessment, you'll be paying by increased dues through borrowing. Those are SBA loans. Those are really important. You can borrow from reserves for 1%, or you can, reach out and try to get private loans. And again, loans increase future dues. And I trust me, your community will always choose to increase future dues rather than pay a large special assessment. Next slide. Pro tips, what kind of quick advice I could give everyone is, obviously, I think everyone probably knows this by now. It's how do you fund earthquake insurance? I'm all about getting things funded without a membership vote, just because good luck getting a membership vote. And I would always advise a board, just as when you put something out to a membership vote and you're a board member, you're abdicating your duties. It's very easy to say that because you're asking individuals to vote in their own individual interest, and you represent a corporation. You're allowing individuals to be individuals. They're not thinking like a corporation. So always try to fund these things without a membership vote. You can do that by keeping the cost of the policy underneath. I think it's a 20% increase in dues, or a 5%, whatever your 5% annual contribution is. I always try to tell boards that's a great place to start on what you can afford. And then the key earthquake provisions that you should be looking for if you have a policy right now. And if you're one of these agents here on the panel, I'm sure they will do this for you. But these are usually free to add on if the carrier will allow you to do it. You always want to make sure you endorse and get coverages for foundations and underground utilities. That's just an endorsement. It's free, but if you don't ask for it, we won't give it to you. Ensuing water damage, that's something that carriers are starting to give a lot now. It used to be a very hard thing to get, but the carriers in California are, if you ask for ensuing water damage, most carriers will give it to you. Again, it's free, just have to ask for it. The removal of the SOV clause, this is a little bit complicated. So just remember I said this, and then ask your agent if it's possible. What that means is like blankets. I think a lot of people have heard the term blankets on fire. That means if you buy $10 million of coverage, you should be able to use the 10 million for one building if you'd like, right? You don't want, if you have 10 buildings, you don't want someone to say you can only have $1 million per building. You just want 10 million, however you want it. Now, it's still very rare to get in California, but more and more carriers are removing these SOV clauses for earthquake insurance and flood. And so you may not be able to get it, but ask for it. See if you can get the SOV clause removed. I know my carriers are starting to do it. And then make sure, and again, if you're with one of the agents on this panel, they're going to do this, make sure you schedule in all the common areas. Again, it's free, but you just have to schedule it in. If it's not in that statement of values, it's not in that application, that carrier will not cover it. It's just, you really have to be diligent. You're doing earthquake insurance policies. And then unit interiors. It used to be with unit interiors for earthquake insurance, it was a very vague, would they cover it or not? It would be based off your CCNRs, but more and more carriers are starting to say, we will guarantee unit interiors plus unit improvements. So again, it's one of those things where just ask if you can get it. And then I will talk about this later. Don't be scared by large deductibles. And we'll talk about why not in a second. Next slide. So a very quick, I'll go master policy, full coverage. If you can do it, right? But I get costs are going up, so it's hard for everyone to do it. It obviously will minimize future large assessments. If you can do it, your association really won't have trouble rebuilding. I promise you that. And the cost usually is about 50 to 90, this is Northern California, $50 to $90 per month per unit owner, I think is probably roughly what the cost would be. And obviously the considerations are it's expensive and divisive. Master policies, partial coverage. I will say most of the master policies I see enforced in California are usually partial coverage. Why communities buy partial coverage is because it's something they can afford. And then with earthquake insurance, because it's elective, you really get more choices on how you want to buy it. And so if your community has 50 million of total insurable value, a lot of boards will say, you know what? I have this probable maximum loss statement from this insurance carrier saying in a 250-year event, they don't expect any more than $10 million of damages. So let's buy 10 million. Let's not buy 50 million. Let's buy less coverage. It's a smart amount. It's what we can afford. And I'm all for it. If you probable maximum loss, again, predicting earthquakes is impossible, but anything that you buy in terms of earthquake insurance will make your life so much easier. And it's not about just the payment of the earthquake policy. Earthquake policies will be collateral for loans. And so those associations, as we'll talk about next, that do get earthquake coverage, they're going to be in the front of the line when it comes to getting SBA disaster loans and private loans, because at the end of the day, we'll talk about that next. Now, the third type of policy you can get is a common area policy. I don't see many communities looking at it, but again, if you can't afford a traditional master policy that includes residential buildings, there is a lot of value in just a common area policy. And now those are excluding the residential structures. And you can do that with carriers now. Now, the value to a common area policy is it's really cheap. If you have 10 buildings, your common areas, your streets, your walkways, your underground utilities, your pool, your clubhouse, if you wanted to insure all those elements, it probably is going to cost you $3,000 or $4,000 a year, maybe $5 to $10 a unit or a month. Now, the value there is, as we learned in Napa, earthquakes with smaller magnitudes, less than 10 shaking, the things that get damaged in smaller quakes are your roads, your carports. And then secondly, so really it's a policy to protect against a smaller quake. And when you don't buy earthquake insurance, the one coverage that your unit owners can't get on their own is common area coverage. They can buy coverage for their residential building, their unit interiors, but because your members can't buy common area coverage on their own, well, that's kind of a good way for the board to say, we're buying common area coverage, it's affordable, and we know you can't get that on your own. So that's how a board could rationalize that. And then obviously, I'm certainly a part of the new custom unit owner program. And really what that is, to make it very simple, is, when we don't buy earthquake insurance as a board, we're leaving all our membership with large special assessments. There is new carriers that have come in to offer custom special assessment coverage. So if you leave, we'll talk about that on the next slide. Next slide. So basically you can create, doesn't cost the board anything. You can create these custom elective programs where unit owners can go buy their own coverage on their own. And so in Northern California, especially, why are rates going up? And this has to do with a lot, but we were dealing with wildfire. It really comes to the reinsurance problem that we're having in our market. I just mentioned this in my breakout. We had really bad modeling in 2017 and 2020. And these bad modeling for earthquakes, as I said, we're more likely to have a much larger earthquake, which is carrying carriers. So rates were going up. And then we came into a very unhealthy insurance market, probably the most unhealthy insurance market we've seen in a long, long time. And what's happening is, as someone has mentioned, is we've had catastrophic losses nationwide from wind, flood, the ice storms, or ice freezes in Texas. And what happens is, even though we haven't had earthquakes in California, these reinsurers, it's all the same bucket of profitability. And they've been getting hit really, really hard. And so because of that, in a healthy insurance market, 1% to 2% of all US premium goes to non-admitted or excess carriers. Right now in the United States, over 10% of all premiums going to excess and non-admitted carriers. And again, we are in a very unhealthy market. Reinsurance rates are going up so much that admitted carriers can't offer their products in certain states because they would start losing money. So they have to leave the state, become an excess carrier, so they have the flexibility to change the rates. And that's just where we are with wildfire and earthquake in California right now. Next slide. So I love talking about this. How much can we borrow? Because I think when you're if you're an association looking at earthquake insurance, I'm all for large deductibles. And large deductibles, you should feel very comfortable with it if you understand the reality is that you're going to take loans out. And then once you understand that it's going to happen, well, then you can feel very comfortable that, oh, this isn't that expensive. Here's an example. And I always say to a community, you can easily loan and afford 15% of your total insurable value through loans easily. So let's imagine we have an association with 30 million in rebuilding costs. That association has 150 units. First and foremost, we're going to apply for an SBA disaster loan because it's a federal loan. It's like the PPP loans that we learned through COVID. It's incredible. You can't get these kind of terms in the private market. Right now, you can get an SBA disaster loan for $2 million. It's interest-free for the first 2 years right now. And then you have a 28-year term after that, and it's roughly 3%. So if we were to amortize that, like what would that cost your association per month per unit owner? The first $2 million, we're going to only have to increase our dues by $57 a month. Well, that's not bad. You know, you just went through the largest earthquake. It affected your community, and you know the first $2 million we can fund by increasing dues by $57. That's not bad. And then let's say we go and get another $3 million through a private carrier or a private bank. Now they're going to give you tougher terms. They won't give you a 30-year term. It'll be closer to a 15 or 20-year term, and the rate will be much higher at 6%. But even with that $3 million private loan, that increases your dues by another $140. So we now know we can do $5 million of loans, and we've only increased our dues by, I think, $195. And again, that means we've just paid for the first $5 million in damages, and we've increased loans by $197. You know, that's expensive, don't get me wrong, but again, you just went through an incredible earthquake, and your association will vote for that versus a large special assessment, I promise you. So if you're a community and you're looking at a 20 or 25% deductible, you can feel comfortable because you will have significant savings. It'll be worth it. And the reality is you're going to do loans, so you might as well get a higher deductible and get the savings on your master earthquake policy. Next question, or the next slide. This is best practices. Not enough people talk about it. If you are on a board right now, the most important thing I want you to leave this remembering is go to your attorney, get your CC&Rs changed. You need to have the ability to borrow money from the SBA without a membership vote. The reason why is when a natural disaster occurs, it will be declared a natural disaster, a federal disaster. The federal government will put $10 billion aside, and it's first come, first serve. So if you're a community and you have to go get a membership vote just to apply for a loan, by the time that membership vote's done, the loan, all the money could be gone. So if you change your CC&Rs to say, after a natural disaster, and this could be wildfire, we want the ability to be able to apply for an SBA disaster loan. Doesn't mean you'll take it, but you want to be able to apply for and get the loan without a membership vote. And that will make sure you're first in line and you get that SBA disaster loan, which you need. And again, it's first come, first serve. Just make sure you spend your $1,200, you change your CC&Rs. That way your board has the ability to, borrow without a membership vote for that small carve out, which is a natural disaster. Next slide. This is something, obviously my program, we can talk about that in another breakout. But again, if you don't buy earthquake insurance, you're leaving your membership with a large special assessment. Everyone has this large special assessment they have to have. The reason why it's so broad in California is what your association governing docs and the courts have ruled is when an association doesn't buy earthquake insurance, the courts and your CC&Rs are going to read is that everybody benefited. And because everybody benefited, everyone's now going to be responsible for all damages. So if you're living in a building and it's not damaged by an earthquake and your neighbor's building is damaged, you're going to pay the same thing that your neighbor paid. So you have this really broad exposure from earthquake insurance. So, your special insurance, your loss assessment or special, assessment coverage becomes very, very important to your membership. Just let them know. And so in that example, we just had that community that was 30 million to replace. And that's easy to find out. If you're on a board, go to your annual disclosure, look how much fire coverage you have divided by the number of units. So that community we just did the example of 30 million of replacement costs, 150 units. Everyone in your community has a $200,000 earthquake assessment exposure. Let your membership know so they can work with their individual broker and procure that coverage on their own. Because just because the HOA may not rebuild doesn't mean your unit owners can't protect the equity in their home. They just need to be able to buy, they just need to know how much coverage to buy. And you as a board, if you're working with your agent, should be able to communicate that to them. Because again, just if the HOA doesn't rebuild, doesn't mean a unit owner can't protect their equity in their home. They just need to buy the right insurance product. And that's it for me. Yeah. Oh, no, you can go back one slide. Sorry. I think I had one more. Yeah. And again, you're just best practices. I think we kind of talked about all this stuff. I left out the legal liability exposures. Again, I can give you on a breakout, I can talk to you things I've heard from attorneys say. I mean, your D&O policy is really, really important, but understand your earthquake insurance options that are available to you. Work with your agents that are here, work with your agents, get quotes, feel comfortable with large deductibles, find out what you can afford, and just do your due diligence, document everything.
Good. So thanks, Dan. We really appreciate your help there. Let's go ahead with Kevin Bullitt.
Hi, everyone. Can everybody hear me? Yay? Okay. So I want to first off thank Dan for that, because I'm a big proponent of earthquake insurance. We have it in our association. And it's important to remember that if you own your own individual earthquake policy for your condominium or home, you can actually purchase loss assessment coverage to help you defray some of the costs if the big earthquake does occur. So that's something to be aware of. And thank you, Dan, for that. Okay, so I wanted to first say I'm really grateful again and happy to be a sponsor, a premier sponsor for ECHO. I've been doing this for years. I love it. I get so much back and I take it back to my associations. I actually took a lot of notes today. I learned from my other professionals in the industry. And I decided that I would talk today about interior water claims, who pays. And I chose this topic because in the last 6 months, we've had a spate of these claims. And I discovered there's a lot of misunderstanding about when the association's insurance is going to come into play, or when does the condominium owners come into play, or what happens if there's 3 or 4 units that are damaged, and then who pays that big emergency restoration bill that we've all seen. So I think it'll be a useful topic, and I hope you enjoy it. Okay, Connor, ready for the first slide. Thank you. So the first place you want to look to ascertain what type of property coverage you have in your association is your CC&R's insurance section. And there you will find a description of what type of property policy the association has. And you will find there are only 3 types. There's what's called the walls out property policy. There's what's called the walls in as built by the developer property policy. And then there's the walls in with improvements insured property policy. So what I'd like to do is just explain how these 3 types of insurance work. And then I'll give you a real good example of a water claim and how each one of these different types of property coverage respond. I think then it will be crystal clear and you'll understand who pays. All right, so a walls out property policy simply means, as the name implies, that the association's insurance will pay for everything right up into the sheetrock, but they will not pay for any interior building fixtures inside of the home. So for example, a water claim, a fire, smoke, a tree falls on the property. If you have an association with a walls out property policy, the unit owner has to pay for all their building fixtures. And by fixtures, I mean the kitchen cabinets, countertop, the flooring, the bathroom, sinks and showers and vanities, the hot water heater, the furnace. And don't forget the wall paint. Wall paint is a very expensive permanent building fixture. And trust me, I know, I just got an estimate for my condo and whoo, it was high. So with a walls out property policy for a condominium owner, you really have to get enough coverage for those building fixtures. Now, there are some benefits to having a walls out property policy. And I probably insure about maybe 10 or 15 associations that chose that type of property policy. The number one benefit is that it's less expensive than the other 2 types of property policies. Why? Because with the walls out property policy, the insurance company is no longer insuring the kitchens, the bathrooms, and all the other fixtures. They're only insuring the shell, the outside. So with farmers insurance, if I have to go, or the board decides they want to go for a walls out property policy, it's going to cost about 20% less. So if you're paying $100,000 a year, that's a big savings, $20,000. If you're paying $10,000 a year, that's $2,000 in savings. That's pretty big. So that's one of the benefits of a walls out property policy. A second benefit is that you're going to have a lot less claims on your insurance record. Because now, let's say, for example, you have a $10,000 property deductible. All those claims that are on the interior, toilet overflow, hot water heater burst, toddler left the sink running, a pipe burst. If all that damage is sustained inside the units, then that unit owner needs to file their own claim under their own insurance to pay for the damages. And there's nothing wrong with that. It's, the damage actually occurred was probably caused within their unit. So the less claims you have, the less you have to pay for insurance premiums. So that's another big benefit of the walls out property policy. Okay, and I think that's it. So we can move on to the second type of property policy, which is called the unit owners. Oh, we kind of moved up on the slides there. It's called the walls in property policy as built by the developer. So what this means is that the association insurance policy will come in after a loss, and if the damage exceeds the deductible, they'll go ahead and pay for the loss, but only with the same quality of fixtures that were built by the developer. I think we should abolish this type of coverage form. No need for it. Why? Because how do you determine the quality of fixtures inside of a unit that were built back in 1978, 1982? How is an adjuster, when he comes out, going to determine that? Is he going to knock on the doors and try to find someone that didn't remodel their kitchen in the last 30 years and say, would you mind if I walked into your kitchen and took some pictures? You know why? Because I'm going to depreciate. I'm not going to pay the full amount for your neighbor down the street who just had a fire. That's a disaster. So if you're an attorney out there and you're rewriting your CC&Rs now, please, please don't even consider writing the walls in as built by the developer property policy. Okay, that's my bandwagon there. So the third type of property policy is called the walls in with improvements insured. By far the most comprehensive type of property policy today for associations. This means now that if there's any type of claim, including a water claim, the association's property policy can come in if the deductible is breached and pay for not only the interior building fixtures, but all those alterations, all those improvements that have occurred in the last 30, 40 years. So the granite countertops, the bamboo flooring, the built-in bookcase, the skylight, the deck. I've seen some beautiful condominiums where someone took out a wall to make it more spacious. So what's the benefit of this type of property policy? There's no benefit to number two, by the way, if you haven't guessed that already, in my opinion. The third type of property policy with everything insured, the big benefit to me is you're going to have a lot of happy homeowners. And I serve on my board, so I know that's a very important thing to have. And when you pay your regular assessments, your regular monthly dues, part of that money goes to pay the insurance. A management firm, the maintenance, and the insurance are probably three of the biggest regular expenses that we have to incur in our associations. So why not give your homeowners the best type of property policy today? And that's a good example. Okay, to sum it up then, if you live in a condominium association, you want to take 3 steps to make sure that you're properly insured. Step number 1, read the insurance section in your CC&Rs. Step number 2, call your association's insurance agent and ask them what type of property coverage form exists today for your association. And it can be a great resource, myself and my colleagues, to explain to you what type of property policy that you need. Okay, and then hang on a second here. So I think that's the third step. I want to give the last thing you should do. Obviously, go back to your own coverages for your building fixtures and make sure you have the right amount of coverage. And I was out in Walnut Creek about 3 or 4 months ago. I was asked to give a talk to one of my associations. And as I was describing the walls in with everything covered type of property policy, which they had, I learned that there were several homeowners that said, oh my gosh, I've been spending $400 or $500 a year, Kevin, insuring our association, or excuse me, insuring my unit, because I didn't know we had the walls in with everything insured property policy. I just took over the account from another company, and I guess their other broker hadn't come out there and spoke to them in person in years. This is something that I like to do on a regular basis. So that's another reason why you want to make sure you're properly insured. You don't want to be overinsured and you don't want to be underinsured. Okay, so now let's take a look at an example of a water claim and how each one of these property policies responds. So let's say that you live in a 4-story condominium complex and you're on the top floor and you have a $10,000 property deductible. Suddenly your hot water heater bursts. And now there's water not only in your unit, but in the 2 units below. Who's going to pay? Well, if you have a walls out property policy, the association's property insurance is not going to pay a penny because all the damage was incurred inside the units. So the unit owner who caused the problem or whose appliance caused the problem, they file their own claim with their own insurance and hopefully they have the right amount of coverage. The 2 unit owners below have a choice. They can file their own claim with their own insurance companies and their insurance companies will pay for the damages. And then they'll turn around and send the bill to the unit owner who caused the problem. Or they could actually say, you know, Kevin, I don't want my insurance to be touched. I'm going to go through the liability coverage of the unit owner who caused that problem. And that is an opportunity you can take. There is what's called a waiver of subrogation that protects the association from subrogation by unit owners, but one unit owner can ask for subrogation or can ask to be made whole again if another unit owner caused the problem. And that's something that you definitely want to be aware of too. So let's take the second type of property coverage. The wall is in as built by the developer, even though I don't like to talk about it. Now the association's policy will pay for the building fixtures, Yahoo! But we know they're not going to pay for the upgrades. So how is the claims adjuster really going to know? The only thing they can fall back on is, well, we're going to depreciate it 10% because your association is 30 years old. And we know for a fact that 30 years ago, a linoleum floor was installed or a Formica countertop. It's not where you want to be. So, but if you have that type of property policy, it will respond, it will pay for building fixtures, but only with the same quality that was built a long time ago. Okay, and the last type of property policy, walls in with everything insured. The association's property policy will swoop in, it'll pay for everything, which is great news. You have happy homeowners. And then the association will typically send a one-time special assessment back to the unit owner who caused the problem, where it originated. You always want to have that written into your CC&Rs. And most CC&Rs that I've read, and I read lots, they have that endorsement or that language in there. And then the unit owner whose unit the water heater burst, they can turn around to their insurance company and say, please pay this bill for me under my loss assessment coverage. And they will do that for you. So I think that's a nice way to go. Everybody's happy. So I think that's it. I could talk about other types of water intrusion claims, but I think what I'd like to do is open it up for Q&A because I love engaging with board members. I'm a board member. And in my last breakout session, it was great. We had a lot of questions, and I think that's probably the best way to go. So thank you, everybody, for your time. And I think that'll do it for me today. And I'll turn it back to David or Connor.